Dan Kemp, address investors' COVID-19 concerns but change the narrative once again. Stock markets are dominating the headlines, as concerns about the economic impact of the COVID-19 strain of the coronavirus draw the focus of investors from the long-term horizon to the here and now. In these situations, many investors naturally extrapolate recent falls into the future and become overly risk-averse. In order to help investors through this period, we must both address these concerns and change the narrative.While COVID-19 is naturally causing concern and may be devastating for those who contract it, from a purely investment perspective, the environment is improving rapidly for most investors and so we are excited about the opportunities ahead. The starting point is important, however. In order to take advantage of the lower asset prices offered by the equity markets, it is essential the portfolio was not overexposed to risk assets before their prices started to fall. Periodic drawdowns are simply part of the market cycle and should not come as a surprise to professional investors. Multiple scenarios rather than optimizing portfolios for one possible scenario. Sensible investment managers consider a range of potential paths and balance their portfolio accordingly. To use Morningstar as an example, we have been warning about the risks posed by inflated asset prices for the last couple of years and hence our portfolios were somewhat defensively positioned by limiting exposure to the most expensive asset classes. We did not remove all risk from portfolios, however, as we were acutely aware that expensive assets can continue to defy gravity for extended periods of time. Providing your investment managers have considered a range of possible outcomes, you should expect the returns of your clients' portfolios to remain within your and your clients' expectations. In contrast, beware of investment managers who are seeking to de-risk portfolios at this stage, as it suggests they were carrying too much risk going into this situation and are now not able to capitalize on the opportunities presented by lower prices. Portfolio exposure. As long as portfolios remain within expectations and risk guidelines, the next priority is to maintain the exposure of the portfolio through this volatile period. Sharp moves in the price of investments change the balance of the portfolio. For example, if 50% of a portfolio falls by 10% and the other 50% rises by 10%, the portfolio will have 5% more in the rising asset than before the price move. Left unchecked, this results in the investor owning increasing amounts of the asset that is becoming more expensive and less of the one that is becoming cheaper. It is therefore essential that investment managers have a robust and responsive drift policy. If you don't know what the policy of your portfolio manager is, now would be an excellent. For more on this story, visit the news article link.